ASA'S webinar that will review the highlights, answer your questions, and offer suggestions on how companies can get the most from the results of ASA'S 2015 Operating Performance Report. Please note that this one-hour webinar is being recorded for replay. Everyone registered for the webinar will receive a follow-up email with notification as to when the replay is available, as well as instructions on how to access it and the presentation slides. Before we get underway, I'd like to be sure we recognize our 2015 supplier partners, who you can see on the screen. They're truly dedicated to the positive development of our industry. When making key decisions in your business, consider these corporate partners that go above and beyond with their support to advance the association's efforts, programs, and services through advocacy, education, networking, and benchmarking. One of ASA's strategic goals is that the members will be more profitable and sustainable as they deliver world-class supply chain efficiency in a changing marketplace. For 33 years, ASA has partnered with Industry Insights, Inc. to provide the only source of industry-wide financial and operating performance benchmarks for the industry. Today, the annual OPR is part of a total suite of business intelligence reports that provide ASA members with reliable and timely industrial data to use when making strategic decisions to fuel growth. ASA also partners with Industry Insights to produce a monthly flash report on profitability, sales, inventory, headcount, and average day sales outstanding, as well as confidential business valuation appraisals. It's now my pleasure to introduce our speaker, Tom Noon, who founded Industry Insights in 1980. Tom's expertise primarily includes the areas of financial analysis, business valuations, profitability planning, and productivity and improvement strategies. He has served as project director in a variety of research and consulting studies for both U.S. and European public and private firms, as well as numerous trade and professional associations. Additionally, Tom has played a major role in both the design and presentation of executive development programs in the U.S. and Western Europe. If you read the Wall Street Journal, U.S. News and World Report, and a number of other magazines, you may even recall seeing him quoted. Before I turn it over to Tom, I want to make sure that everyone is clear. He or she is encouraged to ask questions throughout his presentation. Your GoToWebinar control panel includes web window panes on the right in which you may pose questions and even chat with other participants throughout the event or throughout the webinar. I'll be able to help Tom monitor the control panel for your questions, and periodically he'll be asking us if we have any for him. If you'd like to minimize the GoToWebinar control panel on your right-hand side of the screen, you can use the orange arrow to do so. With that, I'll turn it over to Tom.
Thank you very much, Ben. Well, first of all, I'd like to thank everyone for taking time out of their busy schedules to participate in today's webinar. As you know, this is about the Operating Performance Report that ASA has made available as a member service for the last 33 years, as Ben mentioned. This study is a benchmarking type study that provides you financial and operating ratios against which to compare your own company's performance. What I'd like to do in the session today is talk about why this information is important, what it is, what it isn't, but most importantly, how you can apply this information to your own company. We've learned a lot over the last 33 years, and we've learned what separates out the most successful companies from other companies in the industry. So I'd like to share a lot of that with you here today. I also want to spend a little bit of time up front talking about some of the features of the study to make sure that everyone understands what exactly you do have and what it does mean. Then I'll get into showing some of the actual results of this year's study and show how that has compared by industry segment. And then also do something that I've done many times in the past, and that is look at the profit leaders within the industry. In particular, we'll be looking at plumbing supply companies and PVF companies. And to do this, what we do is we separate out the most profitable companies in each of those segments based on one measure, before tax return on assets, which is an overall profitability measure. We separate out the top 50% best performing companies based on that one measure. Then we run all the statistics for that group of companies in order to see what separates them from the other companies in the industry. And we'll find that for some measures, they don't even do as well as other companies in the industry. But for other measures, they do very well, which leads us to sort of conclude that that's what leads to their high profitability. So we can learn from them. Also, towards the end of the session, I'll talk about partners, what I call partners for profit, distributors and suppliers. And in particular, we have this great resource, the OPR. And it provides a great deal of information about wholesale distribution. But oftentimes we find that maybe your vendors don't really understand your business and try to pressure you into doing things that may not be in your best interest. At the same time, you probably don't understand their business that well. But if you each understand sort of the economics of each other's business, maybe together you can take sort of a partnership approach to the way you do business and get away from what oftentimes is a short-term adversarial type of relationship. So I want to make some comments on that, and then also look at some shifts that have occurred in the industry over the last 33 years. So that's sort of where we're heading. I have a lot of slides to share with you, and I'll go quickly through a number of them, mainly because you will be getting a copy of this presentation after the session, so you can use it for reference if you want to go back to it. Okay, as you know, as a participant in the study, you actually get two separate reports. You get an industry-wide report, which has all the data for all of the different data groupings. It has analysis. It has ratio definitions. It also shows what the survey demographics were, so you can see how many people participated in each of the data groupings. So it's all the information, if you will. Then, in addition, you have what is called the Company Performance Report, or CPR we call it. And this is, in my way of thinking, the most valuable component of the study. This is a confidential, individual report about your own company. All of the financial and operating measures are already calculated for you for your company and shown alongside that of other comparisons for industry firms most like yourself, or the aggregate comparisons of industry firms most like yourself. So hopefully it makes it fairly easy for you to make those comparisons. Now, both of these reports are available through the online portal electronically. So you can prepare, or you can print out as many copies of each as you want. They're both available in a PDF format. In addition, the Company Performance Report is not only available as a PDF, but this year, for the first time ever, is also being made available as an Excel document. So you can do certain data manipulations on your data and the industry data if you so desire. So hopefully, this is providing you a great tool for helping you to control your business better. Now, just a couple comments about the kind of information that's in the individual Company Performance Report, or CPR. One section of the report is something called a Summary Performance Valuation, or oftentimes called the report card. What this does, it looks at a number of key measures and just simply tells whether or not you are good, or strong, good, fair, or poor by that measure. So it compares you versus the industry benchmarks and determines just where you fall. It's not perfect, obviously, because many measures are interrelated, but it does give you some sense for where the red flags may appear and areas that you might want to look at in more depth. Now, there may be a very good reason why you don't compare favorably for a particular measure, and that may not be a problem at all. But at least it's important to understand why you might be different and what the red flags might be. Also, in the individual company performance report, there is a section of trend information and tabular trend information. So depending on how many years you have participated in the OPR, up to 5 years, there will be graphs for 27 key measures of your company versus the industry norm. And also there will also be your information in tabular form. So it's very important for you to look at your own trends, just like it's important to look at yourself versus the industry norms. Now, on a graph, there is a wealth of information. First of all, and by the way, this is a hypothetical company, as indicated by the fact that their measures for the last, in this case, 4 years are identical for all 4 years. But at any rate, on any given graph, it looks at one particular measure. This is net profit before tax to total assets, and it shows how your company has performed for each of the last number of years that you've participated, up to 5 years. In addition, there is a dotted line that plots the typical company in the industry for the last 4, 2, 3, 4, or 5 years, depending on how many years you've participated, that shows how that industry is compared for that particular measure. Then the shaded area represents the difference between the upper and lower quartile. So it's sort of the middle 50% of participants. So on any of these one graphs, you can see how you've trended over the last number of years. You can see how the industry has trended over the last number of years. You can see if you fall above or below the industry typical company for that measure, and you can also see if you fall in or out of the middle range. So there's a wealth of information there to just sort of give you a snapshot for how you compare. Now, we also show your information over the last 5 years, or up to 5 years, depending on how many years you've participated. And this is for all of the financial information in the OPR, not just the 27 key measures that are plotted on the graphs, but all of the financial information. And again, this is a hypothetical company, you can see, because they have the same results every single year. And I want to emphasize that because this study is done in strictest confidence. I won't bore you with all the things we do to ensure confidentiality, but suffice it to say that we do this study in strictest confidence, so these are made-up numbers. And again, it's useful because it's useful to see if you've trended up or down over the last number of years. Now, also in the individual report are the detailed performance results. And these aren't shaded in the individual report like I have on this slide. But basically what it is, there's a column for your firm, and then there are separate columns for all the different data groupings for companies most like yourself. I've just picked 5 examples here of different columns, but at the same time, for your company, there will be the comparisons for companies most like yourself. So you literally can just go across the page and see how you stack up versus your industry peers. And hopefully you compare very, very favorably, but if not, maybe it raises some red flags for you of areas to look at in more depth. Okay, well, why do we even bother with benchmarking? And you may have heard me talk about this before if you've heard me speak, and that is just to look at the dollar amounts of your business doesn't tell you all you need to know about your business. For example, if you came to me and said, Tom, we had $1 million of profits last year. Well, on the surface, I don't know if that's good or bad. If you had $1 million of profits and you're a $10 million sales volume company, I'd say that's probably pretty good. That's 10% profits on sales. If, on the other hand, you're a $100 million company, that's only a 1% profit on sales. So that starts telling me something different. So that's why we look at a financial ratio. A 1% profitability is much different than a 10% profitability. Well, just as looking at the dollar amounts doesn't tell you all you need to know, neither does looking at a ratio all by itself. You need some sort of comparison. One comparison is your own historical trend information, which is in the OPR individual report. Another comparison is how you compare versus your industry peers, which is the essence of this study. For example, if you're a plumbing supply company, and last year your payroll and fringe benefits costs were 20% of sales. Again, I don't know if that's good or bad. I do know, by virtue of having done this study, that the typical plumbing supply company last year had payroll costs, including fringe benefits, that were 15.1% of sales. So if you're at 20% and your peers in the industry are at 15.1%, then that raises a red flag to me. Why are you so much higher? Now, there may be a very good reason for it. It may not be a problem, but at the same time, it may be something to look at in more depth. So use this study as guidelines rather than absolute standards, but if you see something out of line, you need to understand why. And I maintain that you don't have to be a financial expert and you don't have to spend a significant amount of time using the OPR to get great insights about your business. You can just start off looking at your company versus pick one data grouping, like plumbing supply companies of a similar sales volume as you. Focus on that, and then let that dictate what other data groupings you might want to look at in more depth. And there are quite a few data groupings. And as well as quite a few different kinds of areas of your business that are being dealt with. For example, there's return on investment information, income statement information, balance sheet, expense detail, gross margin, asset and financial management, Z-score, productivity, inventory and receivables management. So there's a significant number of ratios in there. As a matter of fact, I think there's about 130 or so different financial and operating ratios. The industry-wide report's about 92 pages this year, I believe, and the individual report's about 20 to 30 pages. So it's very much an in-depth study, but it can be overwhelming. So just focus on those areas first that are the most critical. And very much some of the ratios I'll be talking about here shortly are the ones I would focus on. And then let that dictate others to look at in more depth. Now, all of the data is broken down a number of different ways to try to get you to an apples-to-apples kind of comparison, recognizing that that's not totally possible because everyone is different. But at any rate, we break the data by all responding companies, by sales emphasis. So if you're a plumbing supply company, there's information specifically for other plumbing supply companies. If you're a PVF company, there's information specifically for PVF companies, et cetera, et cetera. There's the high profit group that I've already alluded to within each of the sales emphasis groups. There's also information by sales volume size within the sales emphasis groups, but also we do a breakout of very large companies and very small companies. So again, if you fall in one of those categories, that provides insights for you. There's also branch information, so depending on the number of branches a participant has, you can look at companies with a similar number of branches. And also, for the first time in the industry-wide report, we have included geographic region information this year. We have included it in recent years in your individual report, but this year it's included for all the various geographic regions. Okay, a couple features that I don't want you to overlook as you use the study. Last year, for the first time ever, in the P&L or income statement, we brought purchase rebates up as part of gross margin, so that now purchase rebates appear before operating expenses and therefore play into operating profit. Historically, that wasn't the case for the study. When the powers to be first set this up 33 years ago, purchase rebates just were not a very significant thing. And as a result, they felt that that should be a part of non-operating income. Well, that's changed over the years, and people within their own companies, it became very much common to put purchase rebates as a reduction of cost of goods sold. So we have adapted, and for the second year, that's now shown that way. Also, I've already mentioned that the company performance report, the CPR, is now available not only as a PDF, but in Excel form. And then also last year, for the first time ever, we included an employee turnover ratio, and it's defined in the report itself. And I think it's useful because it does give you that component of your business. So don't overlook those new items that are in there this year. Okay, in addition to the fact that just looking at the dollar amounts of your business doesn't tell you all you need to know, another important reason why the operating performance report is useful is because it's a tool to control your business. And it's difficult to know what's going to happen in the economy. I don't know if you share the same frustrations that I have, but when you start looking at economic forecasts, sometimes they're either all over the board, or at the same time, when you start looking back at how a forecast came out, it doesn't necessarily work out that well. So for that reason, the OPR should be used to control your business regardless of what's happening in the economy. Now, just as an example of what I'm trying to say here, I went back and looked at just 4, but I could have looked at many more, highly sophisticated, very much with good reputations, companies that do economic forecasting. These use big statistical models that bring in all kinds of variables to try to forecast what the economy is. So I looked at what did they forecast back in January of 2014 for 2014-2015. Well, pretty much all of them said that 2014 was going to be around a little over 3%. The actual for 2014 ended up being 2.4%. So they were overly optimistic. For 2015, they were predicting back at that time that it was going to be a better year. It was going to be, one even projected that it was going to be a 4.1% increase in terms of GDP growth this year. Okay, let's look at what they are now predicting as of this year in January. Well, they're all predicting, again, GDP growth in the overall economy of around 3% or slightly above. And for 2016, they're predicting pretty much the same, really, slightly more, I guess. Well, what has happened thus far this year? Well, in the first half of this year, the economy has grown 1.5% over last year. So if you continue that out to the rest of the year, it's on a pace of a 1.5% growth. They're all predicting it's going to be around 3%. So if the economy continues like it has in the first half, they're about half right. So what does that mean in terms of running your business? Well, it means that you need to do something to keep control of your business regardless of what's happening in the economy. You can't just react to the economy. So that's an important use of the OPR, to keep that control of your business. I came across a few quotes by Herb Kelleher, the founder of Southwest Airlines, which has been one of the more successful airlines over the years, that I think illustrates what I'm trying to say. He says, firms that are content to merely swing with the economy usually lose ground to their competitors even during the robust years. So what he's saying is, don't just go through the inevitable process of tightening your belts when things are tight in the economy and then loosening them thereafter. Do a good job regardless. The challenge for success is more than simply staying in business during economic downturns. Rather, success means maximizing both short and long-term success during any business client. And he also says we manage our business in the good times like it was the bad times. I think paranoia makes a little sense. Okay, the OPR provides you information about all the different aspects of your business. And when I say try to control your business, regardless of what's happening in the business environment, I'm saying here are some of the concepts of business that everybody should do at all times. Manage and stay on top of expenses, resist margin deterioration, monitor inventory productivity, manage your cash, control your receivables, manage your debt, etc., etc. The OPR can help you do that because it provides you information about each of these aspects of your business. I could talk for a long time on each one of these and how the OPR does address them, but suffice it to say, you have a tool here for controlling your business. Okay, having said all that, let's look at industry performance over the last year. And in particular, I'm going to take a look at 2014 results, which is what this year's OPR is based on. And I'm going to look at a number of key measures, and I'm going to show you a number of charts that pretty much all look alike in terms of the way they're organized. So hopefully, once you understand it, you'll understand very easily what each chart's showing. Each chart's going to look at one measure. This looks at before tax, return on net worth, and we're going to look at 5 years worth of information and what the industry typical company did based on all responding ASA firms. And what you can see is the typical company had an 18% return on net worth during 2014. You can also see that this has steadily increased over the last 5 years now that we're well through the economic downturn that we experienced in 2008 and 2009. So the industry has come back significantly in terms of profitability. What about net profit before tax as a percentage of net sales? So this is bottom line profits as a percentage of net sales. And basically this is what's driving the previous chart. This is basically a mirror of the previous chart. Profitability in the industry is very much driven by bottom line profit margin. As we'll talk about a little later, you have very thin bottom line profit margins. So if you can somehow get a 0.5% improvement in your bottom line, it has a significant impact on your return on net worth. Okay, asset turnover, which is defined as sales divided by total assets. Interestingly, every single year over the last 5 years, asset turnover has been 2.5 times. So obviously, bottom line profit margin has been the big driver of profitability. What about financial leverage? This is total assets to net worth, the extent to which the typical company relies on debt versus equity financing. And you can see it's been in a narrow range, 1.8 or 1.9 times over the last 5 years. Now keep in mind, as I go through these industry norms, it's nice to know what happened in the industry, but what is most important is how you compare versus your peers in the industry. So think it through that from that perspective as I'm talking about these. Okay, this is payroll costs, including fringe benefits, as a percentage of net sales. Payroll costs, including fringe benefits. The typical company was at 15.7% last year. It's been very steady over the years, but if you look at your company and you're significantly higher than this 15.7%, you may want to question why. Maybe there's a good reason, but you still may want to question why, because this is a critical component of profitability in the typical distributor in the industry. You could look at it a different way, and that is payroll costs represent almost or very nearly 70% of your gross margin dollars. All right, what about gross margin on net sales? Well, I'll show it two ways here. First of all, I'll show it before purchased rebates, because that's the way it was always shown before 2 years ago. And then I also show it after purchase rebates. So just looking at it over the 5-year period here, you can see that gross margin has been sort of up and down, but 2014 is a better gross margin than 2013. If you look at it on the basis of after purchase rebates, in other words, purchase rebates are used to reduce cost of goods sold, which enhances gross margin, you can see that we also saw an increase in gross margin in 2014. So gross margin increased in the industry during the most recent year. What about inventory turnover, which is defined as warehouse cost of goods sold divided by average inventory? Well, that's been in a fairly narrow range. It's somewhat lower this year than last year, but very much in a narrow range over the last 5 years. Well, as you probably know, it's not adequate to just look at gross margin percent alone or inventory turnover alone. A better way of looking at it is a combined measure called gross margin return on inventory, or GMROI. This is a measure that combines both inventory turnover and gross margin into one overall measure of inventory management. And the reason it's useful is because you can be a high margin, low turnover company, or you might be a low margin, high turnover company and still get to a good GMROI. Well, the typical company in the industry had a 124% GMROI, which was up from the previous year. And the main reason it was up is because gross margin was up. Inventory turnover is down slightly, but gross margin was up. And what this means is, the way to interpret this is, the typical company in the industry earned $1.24 of gross margin dollars for every dollar invested in inventory. So they earned 124% on their inventory investment. total operating expenses as a percentage of sales. Also a critical number, because what we'll find when we look at the high profit companies in the industry, they have lower operating expenses as a percentage of sales, and they have lower operating expenses in all the key categories of operating expenses. During the most recent year, this upticked slightly, but for the typical company, it was 24% in 2014. Average collection period on receivables. Days receivables outstanding, how long it takes you to collect your receivables. Typical company has been at 46 days over the last 2 years. You can see it's come down a little bit from the economic downturn period, which stands to reason, because as things loosen up in the overall economy and as business gets better, people pay better. Net sales per employee. This is net sales divided by the number of full-time equivalent employees in your company. The typical company was at $434,000 net sales per employee. Now this chart is not adjusted for inflation. In other words, it's in nominal dollars. So certainly inflation does come into it, but this is in nominal dollars. Also, percent sales change from prior year. How'd the typical company do? Well, it was a 6.4% sales increase for the typical company in the industry during the most recent year, and that is tracked very closely to what it was the 2 previous years. Once we got through the economic downturn, which, by the way, in 2009, the typical company in the industry showed a 17.2% sales decline. Once we got through that, the industry has come back nicely in terms of sales increases. Before tax, okay, let's shift gears a little bit and look at some of these same measures by industry segment now. We've looked thus far at all responding firms. Let's look at a number of charts by industry segment. And here we're looking at plumbing supply companies, PVF companies, plumbing supply and PVF companies, and HVAC and other companies. And just to make some comments as we go along here, the PVF group showed the highest return on net worth profitability during the most recent year. And this was also true the previous year as well, at 24.6%. Now again, as we go through these charts, pick the group that you fall into and think about how you did in that versus the industry peers of your own group. Bottom line profits as a percentage of sales, PVF companies did much better, which drove their high return on net worth. They were at a 5.2% bottom line profit to net sales, by far the highest of the 4. Gross margin as a percentage of sales after purchase rebates. The lowest, interestingly, was the PVF companies. They were at 27.5% gross margin. So, just to recap, they had the highest bottom line profit margin and the highest return on net worth, but the lowest gross margin. And in a minute you'll see why, and that is because they did a better job of expense management just by the economics of their business or just the nature of the people that participated. Okay, inventory turnover by the various segments. And again, this is warehouse cost of goods sold divided by average inventory. The highest inventory turnover recorded was by the PVF companies by far. So the nature of PVF must lend itself to high inventory turnover, and that's a consistent finding with past years of the study as well. Okay, so we looked at gross margin, we looked at inventory turnover. Let's look at the combination measure, which is gross margin return on inventory. And because the PVF companies had the highest inventory turnover by far, even though they were somewhat lower in terms of gross margin, they have the highest GMROI by far. So they're earning $1.63 in gross margin dollars for every dollar invested in inventory, as compared to the other groups, such as the plumbing supply companies, which are earning $1.32 in gross margin dollars for every dollar invested in inventory. All right, employee turnover. Interestingly here, the lowest employee turnover was among the PVF companies. The highest was among the HVAC and other companies. All right, before tax return on net worth for the large versus the small firms. So I'm going to shift gears a little bit here again. We just got done looking at the various industry segments. What about the very largest and the very smallest firms in the industry? Well, looking at return on net worth, you can see fairly close in terms of the profitability between the high or the biggest companies and the smallest companies in the industry. And that was true last year as well. And interestingly, both the big companies and the small companies had somewhat higher overall profitability than all companies overall. What about bottom line profits as a percentage of sales? Well, here, the large companies had the highest bottom line profitability at 6.2%. The smaller companies were at 4.6%. And we can theorize why that might be. Maybe they get buying economies. Excuse me, I said that wrong. It's the small companies that have the highest bottom line profitability, and we can theorize how that could happen because they may just be a little bit more hands-on and can do a little bit tighter control of expense management than a big company. What about gross margin? Small companies also had the highest gross margin as compared to the large companies. Inventory turnover, again, the small companies compared favorably in terms of inventory turnover, fairly close to the large companies, but still somewhat higher. Well, gross margin return on inventory, not surprisingly, was higher for the small companies because they had somewhat higher gross margin and they also had somewhat higher inventory turnover. All right, employee turnover. This is an interesting one. And keep in mind, this is a measure that appeared in the study for the first time last year. And it's interesting here because the big companies had much higher employee turnover than did small companies for whatever reason. And that was true last year as well. So I don't know what's going on there necessarily, other than the fact that maybe the small companies have a more tight-knit group and people tend to want to stay with the companies. But at any rate, that's a substantial difference. Okay, let's shift gears once again, and I'm going to look at a series of charts where we take a look at plumbing supply companies and also PVF companies, and we take a look at all companies and the high-profit companies in each of those two segments. And keep in mind, again, that the high-profit companies are defined as the upper 50% of the most profitable companies based on one measure, before tax return on assets. We look at that one measure, separate out the top 50%, run all the statistics for that group of companies, and try to identify what separates them from other companies in the industry. So it doesn't mean that they are the best performers for each ratio, but they are the most profitable overall. And so let's try to determine what leads to their profitability. Well, the first two charts, or first two graphs on each chart are going to be for the plumbing supply companies, all companies in plumbing supply and the high profit companies. On the right side of each of these charts will be the PVF companies, the all PVF and the high profit PVF. In terms of sales growth, the high profit companies of both segments did somewhat better than did all firms overall, with the PVF high profit companies having much stronger sales growth than did all PVF companies overall. What about profitability in general, as measured by return on net worth? Well, by definition, the high profit companies are higher profit. But what's significant is how much higher profit. The high profit group had a 27% return on net worth in plumbing versus 16.9% for all plumbing supply. And keep in mind, in this number, the all plumbing supply number, the high profit companies are also in there. So if we would have done a data grouping of high profit companies and low profit companies, this differential would be much greater. And similar kind of thing looking at the PVF companies. the high-profit PVF companies did much better. Well, a big reason for it is because of their bottom-line profit margin. The high-profit companies in both groups had much higher bottom-line profit margin on sales than did all companies overall. All right, what about gross margin? Well, interestingly, gross margin wasn't a huge factor. It sort of mixed. The plumbing supply companies' high-profit group did have somewhat higher gross margin, but not substantially. But in the PVF group, excuse me, they actually had lower gross margin. So gross margin wasn't the big factor that led to the high profitability of either group. However, operating expenses was a big factor. Look at this. The high-profit plumbing supply companies had operating expenses substantially below that of all companies overall. And in the PVF group, even greater differential there. And if we did a high-profit and low-profit segmentation, it would even be greater. So expense management is really critical. It's a big factor that separates out the high-profit and the low-profit companies. As a matter of fact, you can break down the expenses by the key categories, which I've done here in looking at general administrative, occupancy, and warehousing. And basically, not in every case, but in pretty much every case, the high-profit companies had lower expenses in each category than did all firms overall. So somehow they're doing a better job of expense management. And I put to you that they probably are just doing a more efficient job of running their business. And when we talk about expense management, we're not talking about just going in there and unilaterally cutting costs. Rather, we're talking about looking for ways to be more efficient that results in lower expenses as a percentage of sales. And the high-profit companies are finding ways to do that. What about inventory turnover? Not a significant difference on the plumbing supply side. They're very close. The PVF companies, however, did have higher inventory turnover. And you recall that the high-profit PVF companies had lower gross margin than all PVF companies overall. So they're obviously making up for it in terms of inventory turnover. So when we look at the combination measure, GMROI, we see that for the high-profit companies in plumbing, there's not a significant difference. But the PVF companies did somewhat better than all PVF companies overall because the high-profit PVF companies had higher inventory turnover. All right, what about payroll and fringe benefits, which is an important expense component? Well, the high-profit plumbing supply companies did somewhat better, not substantially, but somewhat better. But the high-profit PVF companies, wow, they did substantially better in terms of their payroll cost expense management. So that was a huge factor for them. Sales per employee. High-profit companies in plumbing had higher sales per employee. Same was the case for the PVF companies. So again, they're somehow figuring out a way of utilizing their employees better, getting somewhat lower or much lower in the case of PVF companies, payroll costs, and still get higher sales per employee. Employee turnover. Well, in the high-profit group of plumbing supply companies, they actually had somewhat higher employee turnover than all plumbing supply overall. But in the PVF companies, they were substantially less in terms of employee turnover. Average collection period on receivables. Both high-profit companies groups had lower average collection period or days receivable outstanding than all companies overall. How about financial leverage? Well, the financial leverage was the same in the plumbing for both groups, but in the PVF, financial leverage was somewhat lower than all PVF companies overall. All right, well, what do we learn from this? We learned that the high-profit companies in both groups had higher sales growth. That's not always true, not every year, but this year it was certainly true. They also had higher profitability, no surprise there, because that's how we defined them in the first place. They did have higher bottom line profit margin on sales in both groups. Gross margin was sort of mixed. It was somewhat higher for the plumbing companies, but the PVF companies actually had lower gross margin. Inventory turnover for plumbing was very similar for both the high profit and all plumbing overall, but for PVF, inventory turnover was substantially higher for the high profit companies. Gross margin return on inventory was somewhat higher, not substantially higher, but somewhat higher for the PVF, and very close for the plumbing supply. Sales per employee was higher in both cases, and payroll costs were lower in both cases for the high profit companies. Overall operating expenses and expenses for the key category were lower for the high profit companies. Average collection period on receivables was lower for both the high profit groups, and financial leverage was lower for both. Employee turnover was mixed. It was actually higher for the plumbing supply companies and lower for the PVF companies. So I think we've identified some key components of profitability here. One is expense management. I hate to be trite, but every year it shows up as being a key component of profitability. The high profit companies do a better job of expense management. So as you use the OPR, if you see areas that are out of line in terms of your expenses, again, it may not necessarily be good or bad, but at least it's something to look at in more depth. And you might look at your historical pattern over the last 4 or 5 years, which you also have in your individual report, and see if there's an adverse trend in certain expense categories. If there is, then you probably have a problem. Okay. Another reason that the OPR is useful, because it's useful for you and your vendor partners to understand each other. You can maybe share some of the slides that I'm going to show you here with your vendors so that they have a better understanding of you and your business. They have a better understanding of some of the shifts that occurred over the last 33 years in the industry, and also where your sales dollars go, what some of your profitability challenges are. But at the same time, it's important that you understand their challenges as well. And if you do, hopefully you can have sort of a partnership approach to doing business rather than what is oftentimes very short-term oriented and adversarial. Okay, what about some of the shifts in the industry? As Ben mentioned at the outset, we've had the pleasure and privilege to prepare the OPR for the last 33 years. So a couple years ago, at the 30-year anniversary, I went back, and I've updated it since. I went back and took a look at the first 5 years versus the most recent 5 years. And these actually make very good comparisons, because the first 5 years was right as we were coming out of an economic downturn. And now looking at these most recent 5 years, it's the same thing as we're coming out of a significant economic downturn. So we'll take a look at 5-year averages back then and today, and the reason we look at averages because things do fluctuate in any given year, so looking at a 5-year average can pretty much tell you where the industry was and is. And let's take a first look at gross margin as a percentage of sales. And we're looking at this without considering vendor rebates, because that's the way it was done back then, so we don't have gross margin with vendor rebates added back in, but we can at least talk about it here. So let's take a look. Back then we had 24.8% gross margin for that 5-year average, 23.5% for the most recent 5 years. So I think we can conclude that gross margin has actually declined in the industry, especially when you don't consider vendor rebates. What about payroll costs? Payroll and fringe benefits represented 13.8% of sales back then and represents 15.8% of sales today. So a significant increase in terms of payroll costs within the industry. What about total operating expenses? Well, largely due to the increase in payroll costs, total operating expenses have gone from 22.4% of sales way back then to 24.3% of sales today. So that has definitely and significantly increased. Operating profit as a percentage of sales was 2.4% back in the day and 0.8% today. Now again, this is without considering vendor rebates. So the typical company has a negative, should have said that, negative 0.8% operating profit if you don't consider vendor rebates. Well, obviously vendor rebates are significant today, and now we are putting that up as a reduction of cost of goods sold, which enhances gross margin and brings up operating profit. But vendor rebates were only 0.4% of sales back in the early 80s. Now they are 4.2% of sales for the typical company in the industry. So when you add that back in, operating profit becomes a positive. Okay, what about bottom line profits as a percentage of sales? Well, today and back then, these are very close, 1.9% of sales versus 2.1% of sales. So once vendor rebates are factored in today, bottom line profits are essentially very similar to what they were back in the early 80s. Return on assets somewhat favors today as compared to back then. Inventory turnover, absolutely identical today versus that back then. And the combination measure, gross margin return on inventory, also very close, slightly down due to the fact that gross margin is down, but at the same time, fairly close. Okay, as I said, it's important for your vendors to understand the economics of your business. It might be good for you to show them this chart here. This is all ASA firms, and it's a P&L percentage income statement based on this year's OPR results. And the things that stand out here are the fact that you have relatively thin bottom line profit margins in the industry. On this chart, you can see where all your sales dollars go, and you can see it only leaves 4% profit on the bottom line. So if your expenses are 1% of sales or 2% of sales out of line, that has a significant impact on your bottom line and your overall return on assets and return on net worth profitability. So if you're negotiating with your vendors on price, on gross margin, you don't have a lot of room there, and it's important that they understand that. And it's important that they take the attitude that if you're successful, they're going to be successful. At the same time, it's important that you understand where they're coming from. Well, here's a comparison of the typical ASA firm based on this year's results and the typical manufacturer. Several things stand out. First of all, their gross margin is substantially higher than your gross margin, even after the purchase rebates. Also, your operating expenses are somewhat lower than theirs because you, by definition, have to do a good job on efficiency. Your operating profit is substantially lower than theirs because of the fact that your gross margin is much lower. And at the same time, your bottom line profits are substantially, I'll call them, thinner than for the typical manufacturer. Therefore, 1 or 2% of sales is substantial for you, much more substantial for them. Okay, looking at some other measures. Inventory turnover, cost of goods sold divided by average inventory. A manufacturer typically gets somewhat higher inventory turnover than a distributor. Asset turnover, however, is higher overall for the typical distributor because of the fact that a manufacturer usually has more assets tied up in fixed assets to produce the products, and therefore that brings down their asset turnover. Return on assets is higher for the typical manufacturer because they have a higher bottom line profit margin, and the same is true on terms of return on net worth. So what can we conclude from this? Well, we conclude that your bottom line profit margins are very thin. Your gross margin is lower than the typical manufacturer, but you do rely on the purchase rebates significantly. And operating income would actually be negative for the typical company in the industry if it wasn't for purchase rebates. productivity is critically important for the typical distributor. And at the same time, we've seen these shifts that have occurred in the industry. Okay, another chart that you may have seen me show before, I'm going to kind of run through it fast, and one that you should show your suppliers is the importance of turnover for your business. Let's say that you have $1 million to invest and you use it to buy product, so you now have $1 million of inventory at cost. You mark it up 20%, so now you have $1.2 million of inventory for resale. Okay, you eventually sell the product. If it was all cash sale, that's $1.2 million that goes back up to the top as new money that can be put into the cycle to buy more inventory, etc. In all likelihood, it's going to be an accounts receivable sale, which then goes to the top as $1.2 million of new accounts receivable, and therefore it can go through the cycle again. So the idea here is, other things being equal, the more times you can put it through the cycle, the more successful you are going to be. If, however, your supplier wants to load you up with inventory and it gets stuck here as inventory to be resold that's not being sold, then that's going to hurt your cash flow. It's going to hurt your profitability because it's money that can't go through the cycle. At the same time, if your accounts receivable, don't do a good job of accounts receivable, it also stops your money from going through the cycle. So it's important that you and your manufacturing partners understand this and understand that it's a combination of how much you're marking it up and also how many times you put it through the cycle. If you are stuck with inventory that's not selling, then there's all kinds of costs associated with it. And I'll just leave this chart with you because it does sort of summarize some of the inventory carrying costs. Excess inventory could easily be costing you 20 to 25% of the value of the inventory. So again, inventory management is important. Also, another chart, if you and your channel partner, your vendors, can figure out a way to enhance your sales, get incremental sales, such as maybe through co-op advertising or a better job of branding by your manufacturers, then this is going to help you. Again, very quickly, let's say you have $10 million of volume. You have your cost of goods sold, which is 80% or $8 million. Let's say your variable expenses are 8%, your fixed expenses are 8%, and what's left over is $400,000 or 4% sales profit for you. Let's say somehow you can get $1 million of incremental sales, a 10% sales increase. Well, we're going to assume that you get this and your cost of goods sold remains the same at 80%. Your variable expenses remain the same because they're variable with sales, but there's no new fixed expenses. So everything drops to the bottom line in terms of profits. So you have a 12% profit on the new $1 million of sales. So incremental sales are important. So again, if you and your channel partners can plan that together, you're both going to win. So a partnership approach is much different. It's planning for the long term rather than short term. It's being a partner rather than being adversarial. And if you can do that, then it's a win-win. Okay, just to summarize, when you're using the OPR, don't try to digest the whole thing. Start off looking at some key measures. Start off looking at your company versus other companies most like yourself. Compare your results and see where the red flags occur. And if something is out of line, it's not necessarily good or bad, but it's an area you might want to deal with or look at in more depth. And finally, I keep saying start off with some key measures. I've basically talked about the key measures in this session. But here's a chart that shows what I would consider being sort of the 15 key measures to focus on right off the bat. If you focus on these, and you might have a pet measure to put in or take out something here, but this is the tip of the iceberg. If you focus on these, then this is going to give you the best overall view of your business and lead you to other things to look at in more depth. Well, that's pretty much what I want to do in terms of the formal part of the webinar here. I think we have a minute or two for questions. Ben, has any questions come in? And if I don't get them now, you can certainly call me and I'll be happy to answer them.
Yeah, we do have a couple minutes here, we have about 2 or 3 questions here,
Okay.
Tom. First one being, why was the employee turnover ratio included the last couple of years? Does it appear to be becoming a more common issue, or was it just something that was suggested be added?
It was something that was suggested to be added, and I think the plan is to continue having it in there. Now, there's a lot of different ways of defining employee turnover, so it's important that you do understand how it is defined. On page 91 of the full industry-wide report, there is a copy of the survey form, and there's the definition listed there. I'll just quickly read it. It's defined as the percentage of full-time workers employed at the beginning of the year who left the company during the year for any reason except retirement. And then there's an example there that shows what that means. It is important to understand what it does mean because there are a lot of different ways of defining employee turnover. So it's something we're going to keep in there, I think, and monitor over time.
Okay. Second question, asset turnover for all responding firms. What do you see as the main reason that it stayed exactly the same over the last 5 years?
That's an interesting question. I think that's sort of surprising myself. I would have thought that it would be higher during the economic downturn years, and I don't have in front of me what it was in 2008 and 2009, so it might have been down somewhat. I would suspect that it is. I just think that, in general, that most companies in the industry do a pretty good job of managing their assets, especially inventory. And were really forced to do it during the economic downturn, and I think that's carried through because that had such an impact on everybody that they really sort of tightened the belt, and I think they've done a good job since then. So I think, in my way of thinking, that's probably why it stayed steady. It hasn't always through the years, but these 5 years, I think, have been a little bit of an aberration in the sense that we came out of a very difficult period in the economy and in the industry, and people just did a good job, were forced to do a good job and have continued to do so.
Well, thank you, Tom, and that'll do it for our questions. Thank you for an excellent presentation, and thank everybody for participating in today's webinar. Again, the webinar has been recorded for replay. All of you will receive a follow-up email message with a notification as to when the replay will be available and instructions on how to use it. The slides are already available on ASA'S website at www.asa.net. If you click on the Business Intelligence tab, go to Annual Performance Report, and scroll down to Resources. Lastly, there's still time to book a room and register to attend Network ASA 2015 in Chicago here at the Marriott Downtown Magnificent Mile, October 27th through the 29th. We have more than 80 wholesaler firms already registered. We're well on our way to reaching the goal of having at least 120 different distributors represented. So we're looking forward to another very successful convention. This is Ben Stevens with ASA, and our webinar is now concluded. Thank you very much, and everyone have a great afternoon.